Welcome back, dividend investors. Today, we're diving deep into the consumer defensive sector, analyzing four of the biggest players in this space: Hershey Inc., Coca-Cola, Mondelez International, and PepsiCo. These household names dominate the snack and beverage industries, but are they good investments right now? Let's break them down metric by metric to uncover the story behind the numbers. The price-to-earnings ratio helps us understand how much investors are willing to pay for each dollar of earnings. A lower P/E ratio typically indicates a company is undervalued or has lower growth expectations, while a higher P suggests a premium valuation due to growth potential. Hershey currently trades at a P of 18.39, which is well below its 5-year average of 24.58, suggesting it may be undervalued compared to its historical range. However, its forward P/E of 26.17 indicates that investors expect future earnings growth and are willing to pay a premium. Coca-Cola, on the other hand, has a current P/E of 24.61, very close to its 5-year average of 24.40, signaling that it is fairly valued. Interestingly, its forward P/E of 22.21 suggests analysts expect stable earnings moving forward. Mondelez trades at a P/E of 18.54, lower than its 5-year average of 21.65, implying some potential undervaluation. With a forward P/E of 19.99, the market anticipates modest growth. PepsiCo, with a P/E of 18.63, is also below its 5-year average of 24.55, making it appear undervalued. Its forward P/E of 17.24 suggests that future earnings growth may be slower than its peers. The price-to-earnings-to-growth ratio factors in growth relative to valuation. A lower P/G ratio generally indicates a stock is fairly valued relative to its growth rate, while a higher P/G ratio may suggest overvaluation. Hershey's P/G ratio of 20.90 indicates it trades at a substantial premium to its growth rate, suggesting it may be overvalued. Coca-Cola's P/G ratio is 4.04, implying a more reasonable valuation considering its growth outlook. Mondelez's P/G ratio of 3.45 shows it is moderately valued relative to growth, while PepsiCo's 3.91 suggests a similar balance of price and growth expectations. Insider ownership reflects the confidence of a company's leadership. Higher percentages suggest stronger belief in the company's long-term prospects. Hershey stands out with an impressive insider ownership of 27.34%, indicating strong internal confidence. In contrast, Coca-Cola holds 0.78%, Mondelez 0.19%, and PepsiCo 0.34%, which are all low but typical for large-cap consumer defensive companies. Return on equity, return on assets, and return on invested capital measure how efficiently a company generates profits from its resources. Hershey leads the pack with a return on equity of 50.4%, return on assets of 17.88%, and return on invested capital of 28.49%, indicating exceptional operational efficiency. PepsiCo follows with a return on equity of 52.42%, return on assets of 9.58%, and return on invested capital of 21.43%. Coca-Cola has strong figures as well, with a return on equity of 41.86%, return on assets of 10.72%, and return on invested capital of 19.32%. Mondelez lags with a return on equity of 16.69%, return on assets of 6.59%, and return on invested capital of 13.16%, showing comparatively lower efficiency. Share buybacks can enhance shareholder value by reducing the number of shares outstanding. Over the past decade, Hershey has decreased its shares by 0.94% compound annual growth rate, PepsiCo by 0.76% compound annual growth rate, while Coca-Cola's share count has remained flat. Mondelez has been the most aggressive, reducing its shares by 1.93% compound annual growth rate. Hershey boasts the highest earnings per share of $9.37, but its projected 5-year growth rate is just 0.88% compound annual growth rate, suggesting a slowdown. Coca-Cola, with an EPS of $2.88, has a higher growth projection of 6.09%. Mondelez has an EPS of $3.45, with future growth estimated at 5.37%. Finally, PepsiCo sits at $8.16 with a future EPS growth of 4.77% compound annual growth rate. Earnings growth and free cash flow are also critical indicators of financial health. Companies with consistent growth in these areas tend to have sustainable business models. Hershey has had a consistent EPS growth over the last decade. However, the guidance the company offered us during this month is at least to be worried, because it is expected to decline almost 30% during this year due to high cocoa futures prices. Mondelez, despite having also a decline for the next year, its business is more diversified and does not depend much on cocoa prices. And if we have a look at Coca-Cola and Pepsi, the growth is so consistent around 4% and 6% respectively. Over the past decade, Hershey has grown its free cash flow per share by 8.75% compound annual growth rate, highlighting strong cash generation. Mondelez follows with 7.1%, while Coca-Cola lags with 2.4%. Here it is to be mentioned that this year Coca-Cola free cash flow is too low due to a huge change in working capital of around $6 billion when usually is below $1 billion. So normalizing this exceptional case, the free cash flow per share would be 2.32 per share. Notably, PepsiCo's FCF per share has slightly declined by -0.52%, indicating weaker cash flow growth. For dividend investors, yields and growth rates provide insights into income potential. A higher dividend yield is attractive for income-seeking investors, while strong dividend growth suggests a company's ability to increase payouts over time. Hershey has a 3.18% yield, growing at 9.4%, which is solid but not the highest, and has a decent payout ratio. Coca-Cola's yield is slightly lower at 2.88% but has grown at 4.78%, so less initial yield and expected growth but a more consistent dividend growth payer with 63 years of consecutive dividend growth. Mondelez offers a 3.31% yield, growing rapidly at 12.06% with some years of impressive growth initially and now closer to 10%, making it an attractive option for dividend growth investors. Finally, PepsiCo, another dividend king, stands out with a 3.74% yield, offering the highest immediate income but growing at 7.4%. So if the dividend grows more quickly than the free cash flow, we have what we can see: a free cash flow payout ratio over 100%. Margins are where the magic happens, how much profit a company keeps from every dollar of sales. And guess what? Hershey is leading the pack with an impressive operating margin of 22.78% and a profit margin of 19.87%, showing it knows how to turn sweet sales into even sweeter profits. Not far behind, Coca-Cola flexes its financial muscles with an operating margin of 21.25% and a profit margin of 22.73%, proving why it remains a beverage powerhouse. Meanwhile, Mondelez and PepsiCo are playing catch-up. Mondelez posts an operating margin of 13.93% and a profit margin of 12.65%, while PepsiCo delivers 15.5% and 10.43%, respectively. Clearly, when it comes to squeezing out profits, Hershey and Coca-Cola are setting the pace. Turning to revenue and earnings growth over the last 8 years, Hershey and Coca-Cola demonstrate positive evolution, reflected in similar total returns compared to the Consumer Staples ETF, XLP, over the last 5 years. PepsiCo and Mondelez, however, show more flat evolution but have underperformed XLP in total return. Now, let's talk about debt, because how much a company owes can make or break its future. Hershey stands out again with the lowest leverage, boasting a debt/EBITDA ratio of 1.76 and a debt/FCF ratio of 3.88. That means it's managing its debt efficiently while still churning out profits. Coca-Cola carries a bit more weight with a debt/EBITDA of 2.81 and debt/FCF of 4.46, still manageable but noticeably higher. Mondelez and PepsiCo? They're playing in the heavyweight division. Mondelez clocks in with a debt/EBITDA of 2.28 and a hefty debt/FCF of 5.11, while PepsiCo takes the crown with 2.69 and a staggering 6.26, meaning it relies heavily on borrowed money. When it comes to staying light on their feet, Hershey is the clear winner, while PepsiCo carries the biggest burden. Over the past 52 weeks, Coca-Cola has delivered a 17.45% return, outperforming its peers. Hershey declined by -7.92%, Mondelez by -12.51%, and PepsiCo by -9.60%. While viewing its market caps, all of them are considered large companies with over 10 billion market caps. Now, let's talk about the crystal ball moment: analyst expectations and fair values. Analysts have set varying price targets for these companies over the next 12 months. Hershey has a price target of $161.49, representing a downside of 6.29% from its current price of $172.34. My fair value estimates tell a very similar story. For me, Hershey is close to its fair value at $158.11. That suggests it is overvalued right now. Continuing with Coca-Cola's price target is $73.92, which actually represents an upside of 4.3% from its current price of $70.87, indicating that analysts see the stock as potentially fair valued. And for me, Coca-Cola, with a fair value of $54.14, appears currently overvalued. Now, Mondelez has a price target of $66.09, with an upside of 3.3% from the current $63.98. And for me, with a fair value of $59.42, can indicate a little bit of overvaluation, but also a good entry point. Finally, PepsiCo's price target is $163.73, representing an upside of 7.7% from its current $152.02, with a fair value for me of $152.07, which is close to the current price and can indicate an excellent opportunity to start a position. These valuations indicate that while there is some potential for growth, investors should tread carefully and consider these stocks' current pricing relative to their intrinsic values. Each of these companies offers unique advantages. Hershey leads in profitability but has limited future growth. Coca-Cola shows steady growth and solid returns. Mondelez provides strong dividend growth but faces flat revenue performance. PepsiCo offers a high dividend yield but lags in cash flow growth. Which one fits your portfolio? Let me know in the comments, and don't forget to like, subscribe, and hit the notification bell for more financial insights. Until next time, happy investing!